Hey everyone, welcome back. Today we are diving into an absolutely wild mystery happening right now in the energy sector. We're looking at a company called SM Energy, and let me tell you, their financial data is currently painting a picture that is, well, wildly contradictory. I mean, we're talking about a true financial paradox here, where the market's enthusiasm seems completely detached from the underlying hard math. So we're going to put SM Energy through a comprehensive financial health check in this explainer just to see if we can make sense of this giant puzzle.
Okay, let's dive into this because their current trading price is the real hook here. As of the last close, SM Energy's stock was sitting at $31.03. But what's going to immediately grab your attention is that massive bullish momentum. The stock is up over 67% year to date. If you're a momentum investor looking at this, you are probably thrilled. The market is aggressively buying in, and on the surface, things look absolutely fantastic. But brace yourself for some serious visual whiplash, because right beneath that surging stock price lies this underlying number, an intrinsic fair value price of just $11.50. When you calculate the true value of the business based on the cash it actually generates, it's drastically lower than what the market is currently paying. This creates a deeply negative margin of safety at minus 169%. No way, right? This right here is our central paradox. How in the world can a stock rocketing up 67% actually be valued at nearly a third of its trading price?
So here's our roadmap for figuring this out today. 1. The stock price paradox. 2. Dividend and growth trends. 3. Margins and profitability. And 4. The valuation verdict.
All right, let's kick things off with Section 1, the stock price paradox. It has been a total roller coaster of historical returns.
And this brilliantly illustrates exactly the kind of wild ride SM Energy investors have been on. To really get what's happening today, we have to zoom out and look at this timeline. In 2020, the stock plummeted nearly 45%. Then, in 2021, it absolutely exploded with a staggering 382% gain. Fast forward a bit, and we see it dropped almost 50% in 2025, only to bounce back 67% this year in 2026. Basically, this proves that SM Energy is no stranger to wild extreme swings. It is a highly volatile asset.
Now, you might be wondering where that $11.50 valuation came from earlier. Well, a discounted cash flow model, or DCF, strips away all that market hype and looks purely at expected future cash. It cuts right through the extreme volatility we just mapped out and zeroes in on what the business is actually projected to produce. And right now, those cash flow expectations are flashing a really heavy bearish signal against today's stock price.
Moving right along to Section 2, dividend and growth trends. Here we're looking at yields versus contractions.
On the dividend front, the news is actually quite positive. The current yield is a very respectable 2.84%, but look at that 5-year compound annual growth rate, an aggressively positive 113%. And even better, they are doing this really safely. Their payout ratio is an incredibly low 14.51%, which just means they're paying out less than 15% of their earnings as dividends. That leaves plenty of room for future growth, and they've already consistently raised this dividend for 4 consecutive years.
But actually, scratch that. The growth story gets a whole lot more complicated when we look past the dividend. We've got a stark contrast here. On the long-term horizon, their 5-year revenue growth is super strong, at nearly 23% annually. However, check out the short-term income contraction. Over the last 3 years, their net income has actually been shrinking by over 16% annually. Free cash flow is contracting right along with it. So while the company grew significantly over a 5-year window, its recent ability to actually generate bottom-line income is completely stalling out.
Let's jump to Section 3, margins and profitability. Basically, how good are they at keeping what they earn?
Think of this like a single SM Energy dollar. About 26 cents of that goes straight to the cost of goods sold. Roughly 49 cents gets eaten up by operating costs and taxes. That leaves them keeping nearly 25 cents on the dollar as pure net profit. On its face, keeping a quarter of every dollar as profit is remarkably solid. However, the catch is in the trend line. That 24.95% margin is actually down over 34% from its own 3-year average. They are profitable for sure, but they are becoming significantly less profitable than they were just a few years ago.
So the crucial point is their return on invested capital. ROIC currently sits at 7.83%. This metric basically tells us how efficient a company is at using its capital to generate returns. What's alarming here is that 7.83% represents a steep 50% plummet from its 3-year average of around 15.9%. Their efficiency in allocating capital to generate profit is declining rapidly, and that acts as a major potential red flag for long-term investors.
Which brings us to our final section, the valuation verdict. What are we actually paying for?
To answer that, we have to look at the PEG ratio. A PEG of 1 is usually considered fair value, but SM Energy's current PEG is an alarming negative 0.35. Yep, negative. As you might know, a negative PEG means expected earnings are actually shrinking. You are literally paying a premium today for a contracting bottom line.
Now, what's really interesting about this slide is how it completely shatters the illusion of this being a quote-unquote cheap stock. At first glance, a PE of 5.5 seems like an absolute steal, but look at that next column. That 5.5 PE is actually 95% more expensive than the company's own historical 5-year average. The price to sales is up almost 64% from its baseline, and EV to EBITDA is up about 41%. Relative to its own history, you are paying a massive premium for a company with declining short-term fundamentals.
Adding yet another layer of risk to this premium valuation is their liquidity. A quick check of their current ratio shows it sits at 0.69. To put that into perspective, for every dollar of short-term liabilities and debt they owe, they only have 69 cents of liquid, short-term assets on hand to cover it. Not only is this below 1, but this metric is down 27% from their 5-year average. So their balance sheet is getting tighter right as the stock price is getting more expensive.
Which leaves us with the ultimate question of this explainer. Is the market simply acting irrationally, chasing momentum in a highly volatile stock during this massive 67% year-to-date run? Or are all of these contracting fundamental metrics, the negative fair value, the shrinking ROIC, the tightening liquidity, somehow missing a bigger piece of the future energy puzzle? The numbers absolutely scream overvaluation, but the market's enthusiasm is telling a totally different story. So the question for you to consider is this: when the dust finally settles, will the momentum or the math ultimately win out?